So this is a joint paper with Marco and Christopher Palmer. So I think I shouldn't spend too much time to say how important are all of these large-scale asset purchase programs. So basically, nowadays we have this book. It's called The Only Game in Town, and it seems that it is basically the only game in town that we are playing with it. That Japan is doing that, ECB is doing that, US did a lot of that. So for example, for just the United States, within 5 years, the balance sheet of the Federal Reserve increased from just $800 billion to almost $4.7 trillion. So it was, the programs that we did was super large. What was the problem? The problem is that we didn't have a clear idea about why these large scale asset purchase programs are affecting the real economic activity. And whenever you want to do one of these large scale asset purchase programs, there are at least two very important parameters that you have to decide about it. One is that what's the size of the program? How much assets do you want to purchase? But then perhaps more important than that, what is the type of assets that you want to purchase? And if you look at within the US, the first round of the larger scale asset purchase programs, they mainly purchase mortgage-backed securities. The second round, they purchase treasuries. The third round, they purchase a combination of mortgage-backed securities and treasuries. If you look a little bit broader, in Japan, they even purchase corporate bonds, stocks. So there's always this very important question in front of you that conditional on assuming that you want to do larger scale asset purchase programs, what exactly do you want to purchase? And we have, it's super important to have a very clear, at least a theory and some empirical facts supporting that about what is the right mix of the assets that we want to purchase. So in order to give you some little background about just the theoretical work on this, why it's important what the Fed is purchasing. If you start from just the pure complete markets, these larger scale asset purchase programs are just irrelevant. So it doesn't matter what you do. It's just, a transfer that, the market is going to undo it. It's not going to work. You need some imperfection before any of these larger scale asset purchase programs have any real effect. Okay. So, but then these imperfections, there are two classes of models in which these larger scale asset purchase programs have a real effect. The first class is the class that the segmentation in the market is broadly defined. So what is that? So for example, the segmentations in which different investors in the market are based on, for example, duration. There are some investors in the long-term assets. There are some investors in the short-term assets. So if you have this kind of segmentation, no matter how much you are reducing the short-term interest rate, the effect of buying some long-term assets is going to be beyond that. Why? Because whenever you are reducing the short-term interest rate, this is not having the same effect on all of those investors who are very active in the long-term assets. Whereas when the Fed is purchasing long-term assets, that's reducing the interest rate on the assets that they are facing. But then the main consequence of this is that within the class of long-term assets, those investors are going to rebalance their portfolio, and therefore the exact type of what the Fed purchases is less important. It's only about the duration of what the Fed purchased, because those long-term investors are going to reallocate their portfolio within the long-term assets. And although the Fed is only buying long-term treasury, for example, the investors in the MBS market are also going to be affected because both of these securities have long-term duration. There is another class of imperfections. There is another class of models with imperfect financial institutions that in which not only the duration of the asset that the Fed purchases is super important, but also the exact asset class that the Fed is purchasing. So that's basically called either the narrow segmentation models or the capital constraint models. So what are those models? In those models, the investors are much more specialized than just long-term investors versus short-term investors. So for example, you have investors in the mortgage-backed securities. You have investors for the jumbo mortgages. And then when the Fed is purchasing mortgage-backed securities, it affects the production of mortgages much more than other long-term assets. Okay? So in these class of models, it's super important what the Fed is purchasing beyond the duration, and it's more about the exact identity of the assets that the Fed is purchasing. So for example, Bernanke, at least both in his book and in his Jackson Hole speech, in many places that he talked about it, he had very much this view of the broad broad spillover channel, that it's true that we are purchasing long-term assets, but the investors are going to reallocate their portfolio, and this is going to spill over to the rest of the economy. So that was very much Bernanke view, both, in his speech and in the book. So if you read the book, it's all throughout, he's talking about this spillover channel. But then you can think also about this. There are, especially in Europe, there are more people that are talking about this. That we know that the banks are not, working, and so basically the money goes exactly where we are injecting the money. So we are not. It seems that at least some of the people on the board of the ECB, they are already agreeing that there is much less spillover, and it's very important what we are purchasing. And I think for that reason, they from the beginning they chose a broader, set of assets that they are purchasing. So what we want to do in this paper is exactly testing these two views, whether it's the broad segmentation channel or the narrow segmentation channel. So that's the main thing that we want to test. On top of the previous literature, we are also going to look at the quantities beyond the effect on the prices. So before saying what we do, let me start from, so what is the main identification problem that any paper that wants to identify something in the aggregate is facing? QE didn't happen in a random time. QE happened exactly at the time that everything else was bad. It's just a very endogenous time. And then the problem is that the announcement of that is going to be correlated with many other things. So the usual solution for the literature is to look at the very high frequency event study. What is this high frequency event study? You look at 20 minutes before Bernanke opened his mouth, 20 minutes after that. This is the effect of Bernanke's speech. Okay. And we hope that within these 20 minutes, nothing else happened. So that's the typical solution in this literature. What are the problems with this kind of identification? First of all, during this time, Andres has a very nice paper. There are a few other papers also that shows this, that there is a very limited pass-through of prices in the secondary market to the primary market. So for example, what people are doing, they are looking at the prices of the secondary market for the mortgage-backed securities. And when they see that the interest rate in the secondary market for mortgage-backed securities decline, they infer that that means that households are also paying lower interest rates. But then during this time, there was very limited pass-through of the interest rate. So it could be that the interest rate in the secondary market declines, but this doesn't pass to the primary market. The other problem, and more fundamental problem, is this second one. That is, the prices are observed conditional on origination. Last week in my class, I had one of these, the CEO of one of these REITs, and he was saying, yeah, at the time, the rates were very low, but we couldn't originate any new corporate bonds. We couldn't go to the market to issue any new corporate bonds. So the prices were really low, but for those who could, who could get it, not for, even a BBB rated, REIT. And then a more fundamental problem is that, think about December of 2008. This is the first time in the history of the United States that Bernanke announced that they are going to purchase mortgage-backed securities. And expecting that the market in 20 minutes will find out exactly how all of the channels, find out all the channels through which this is going to affect the real economy. I think it's a little bit beyond what, for example, Bernanke Kotner did in their original paper. The original paper was all about the conventional monetary policy, which, we have been doing that for the last 80 years. So perhaps market find out exactly what are the channels. This is a new policy. I think it's a little bit of a stretch to assume that market will find out everything exactly. So what we do instead in this paper is, we are taking a different approach. We want to look at different segments of the mortgage market that they are affected with the Fed policy differently. So in particular, within the mortgage market, you have these two very important segments of the market. One is just the conforming mortgages, eligible for the Fed purchase after the financial crisis. Almost all of it is is financed by GSEs, by Fannie or Freddie. And then you have another segment of the market is the jumbo market. So this jumbo market from after the end of 2007 afterwards, so basically from 2008 afterward, there is no securitization. Almost all of it is left on the balance sheet of the banks. So basically you have these two segments. One of them is financed by the banks directly. The other one is eligible for the Fed purchase and financed by Fannie or Freddie. One of them, Fed is going to intervene in that market, by buying mortgage-backed securities. The other one, the Fed is not going to intervene in that. Other than these two, they are very, they have very similar, they have very similar characteristics. Both of them have long duration. Both of them are about the housing market. So they are going to be affected by the recovery of the housing market very similarly, especially if we look at the regions that they have both conforming mortgages and jumbo mortgages. So this is exactly what we want to do. So we want to look at these two segments of the mortgage market and look at the differential behavior of these two segments in response to the Fed action. So in particular, for example, we are going to look at both the interest rates and, for example, the refinancing volume. And then we look at the response of these, differential response of these two segments of the market to different announcements of the QE. Okay. So while basically the main effect may not be completely identified and it could be correlated with other things, this interaction term that is capturing the differential response of the jumbo market versus the conforming market, this is slightly more identified. Okay, and if we, for example, if in the regressions we find out that this beta coefficient, the differential reaction of the jumbo market and the conforming market is close to 0, that means that actually it really didn't matter that much what the Fed purchased. There was a lot of a spillover, and jumbo market also benefited equally from all of these unconventional monetary policy then, compared to the conforming market. If, on the other hand, we find out that this beta is very much negative, meaning that we see much more reaction in the conforming market compared to the jumbo market, that's more an evidence supporting the very narrow segmentation channel. Okay. So just a preview of the results. So what we find is that during QE1, in which the Fed mainly purchased mortgage-backed, the main action of the Fed was purchase of the mortgage-backed securities, the origination of conforming mortgages increased by 170%, whereas the origination of jumbo mortgages increased only by 20%. So there is a huge gap in between origination of conforming mortgages and jumbo mortgages. We didn't see this gap in any other episode from 2008 afterward, especially in response to QE2, which didn't involve any mortgage-backed security purchase, or during QE3, in which now banks are in a much healthier position. So perhaps, that's another very important thing, that it really matters what the Fed purchased when the banking sector is not in a good shape. Okay. And then after that, we go to the household level result, and we show that there is a very important complementarity between the GSE actions or the policies that we had at the mortgage level and the Fed action. So if, for example, if we were relaxing the LTV requirements much sooner, we could have been, the Fed actions during QE1 could have been much more effective than what it was, in the real world. And we are going to show that this is coming from two important channels. One is that if we were relaxing the LTV requirements at the time, we would have had more refinancing, especially from the regions that were hit the most. But more important, perhaps equally important, was we are going to show that there were a lot of households that their LTV was, for example, 90%, so they were not eligible for a conforming mortgage. But the rate that they were paying was 6%. If they were refinancing their mortgage, the rate would have, the new rate was 4.5%. That gives a lot of incentive for these households to cut their consumption, to just save more, and therefore have enough money to just cash in and then refinance. So you can do you can think about this from the point of view of the Euler equation, and you can see that in this environment, the lower is the interest rate, the higher is the incentive of the person to save, and the higher is the incentive of the person to cut the consumption. So it's exactly the opposite of the prediction of the typical Euler equation, that the more you are reducing the interest rate, the lower is the incentive of the household to save. Okay. So what I'm going to do now is, talking a little bit about just, the background of the different rounds of QE and the data that we use, the main results, and then I'm going to move on to the household results. So perhaps for people in this room, you all know this. So basically, let me also come here. So the first round of QE1, it has started by, end of November 2008. Bernanke saw that, mortgage-backed securities market, there's a rise in the spread in that market. So he thought that he should do something about this market. So that's very interesting, that the beginning of the QE didn't come from that we should do unconventional monetary policy. He actually saw there's a problem in the mortgage-backed securities market. He wanted to fix that. He talks with his legal advisor. He says that this is within the scope of what the Fed can do. And then he goes out without any FOMC meeting. He says that we are going to purchase $500 billion of mortgage-backed securities. So that was the first round of QE1. Then they extended the program. They said that we are going to purchase a little bit more of the long-term treasury, but also extending, we are going to buy another $800 billion of mortgage-backed securities. During QE2, Fed didn't purchase any mortgage-backed securities. They only said that we are going to purchase long-term treasury. Then they had the maturity extension program. They said that we are going to sell the short-term assets, buy long-term assets. And then they said that the proceeds from the prepayment of mortgage-backed securities, we are going to invest it back in the mortgage-backed security market. So that's why you see that during MEP, they they increased the purchase of mortgage-backed securities. And then we have QE3, in which they said that we are going to buy about $80 billion per month of mortgage-backed securities. Later on in May and June, Bernanke said that maybe we are not going to purchase mortgage-backed securities forever. That's the tapering event. And then actually they reduced the flow of the purchase of mortgage-backed securities. How important was this in terms of the aggregate origination? So if you look at the Fed net purchases versus the total GSE originations, there were times that they were almost the only game. The main by far the main buyer of mortgage-backed securities. Okay, so the data that we use is basically, a merger between LPS and Equifax data. This is, this is called CRISM data. I think, Andres' paper was one of the first papers that used basically this data. The main advantage of using this data compared to the more traditional LPS data is that you can track borrowers. So I can see what was the previous mortgage contract that you had and what's the new mortgage contract that you just move into that. So, and that's super important for us when we move on to the household part, in which we want to see what was the reaction of the households, not only the origination of the mortgages. Okay, so the main result, let me first start with the interest rate result. In the next graph that I'm going to show you is just estimating the interest rates after adjusting for the credit score of the person and the LTV of the person. So we are going to estimate two separate regression results. One is for the jumbo mortgages, fixed rate jumbo mortgages, 30-year fixed rate jumbo mortgages, and then the other one is for conforming mortgages. Then in the tables that I'm going to show you is, a little bit more, we are putting a little bit more control. So we are looking at the interest rate that a household in a county at time T paid, controlling for all of the borrower characteristics, controlling for whether, basically we are doing an event study. We are looking at the 3 months before, 3 months after the announcement of the program. This is the main effect of the program. So this is on average how much, the conforming mortgages, for example, were affected with the announcement of either QE1, MEP, or QE2, QE3. And this theta2 parameter is going to capture what was the differential effect of this announcement. So for example, when they announced QE1, what was the differential response of the differential reaction of the interest rates of jumbo mortgages compared to the conforming mortgages? Okay, so if we look at, for example, let me start with the graph. So if you look at what happened for the interest rate of refi mortgages after the announcement of QE1, you see that just after the announcement, there was a huge decline in the interest rates. For conforming mortgages, it's about 150 basis points. For jumbo mortgages, it's about 90 basis points. So the gap is increasing by about 60 basis points, 50 to 60 basis points. But both of them declined. The gap is increasing by 50 basis points. No such a differential reaction until we enter into the tapering situation. So let me do it a bit more formal. So here you can see that after you control for all of these borrower characteristics, conforming mortgages interest rate declines by about 110 basis points after the announcement of QE1. So this is basically comparing mortgages originated 3 months in the months of December, January, February of 2000. December of 2008, January, and February of 2009 compared to the 3 months before that. But then you also see that the spread between jumbo and conforming mortgages increased by 50 basis points. And this is after you control in a very nonlinear fashion for all of these borrower characteristics. And just to give you an idea about how large is this 50 basis points, this is equal to the increase in the jumbo conforming spread after the collapse of the private securitization market. So after the entire private securitization market collapsed, this spread also increased by 50 basis points. We don't see any differential effect during QE2. Some effect, some small effect during MEP. The next time that you see a very differential effect in terms of the spread is during the tapering. And again, tapering is exactly the opposite of QE1. So you have one segment of the market that the Fed is saying that we are going to get out of this, and the other segment is the same as before. So we are expecting something the opposite of QE1 to happen during the tapering part. Okay. So that was about the interest rates. But then if you read all of these anecdotes, so maybe, if you only look at the interest rates, you will say, yeah, there was limited spillover, but there was a lot of spillover. At the end of the day, it's true that, for example, after you control for all of these things, conforming mortgages, the spread declined by 110 basis points, but even jumbo mortgages spreads declined by 60 basis points. So there was some spillover. What's the problem? The problem is this, that during this time, and you read all of the anecdotes, they say that if you want to get a jumbo mortgage, it's really hard. Your LTV should be really low. It's not that all the information was in the prices. And all of those prices that we observed is conditional on being able to get a jumbo mortgage. So for that reason, maybe looking at the quantities is a more informative, way to think about this. And exactly for that reason, we look at the quantities. So this is I think, the selling graph of the paper. So if you look at mortgage originations above and below the conforming loan limit and above the conforming loan limit. So below the conforming loan limit, these are the mortgages eligible for the Fed purchase, and these are the mortgages not eligible for the Fed purchase. And you see that after the collapse of private securitization, these two were tracking each other almost always, except during this time. So you see that, they both declined, they both, increased during QE2. It's exactly during this time that the Fed is purchasing the blue line, the Fed is not purchasing the red line, and the origination of the blue line increased by about 150%, whereas the origination of this increased only by 20%. So you see that if you look at the origination amount, the amount of spillover to other market is much less than what you were expecting. Okay. And it seems that it was mainly the direct funding channel, that the Fed is almost financing all of the purchases of mortgages originated, conforming mortgages during this time. And therefore, there was a lot of origination of these mortgages. There was other kind of mortgages held on the balance sheet of the banks. Although the rates were much lower, the banks didn't originate that many of those. Okay, again, now here, we are looking only at the counties for which there has been enough jumbo originations. So that's about only 48 counties in the US. And then we look at the 3 months before, 3 months after. So for each county months, we have two observations. How much jumbo mortgages were refinanced and how much conforming mortgages were refinanced. And as you can see, the origination, this is 100 log points or 170%. It's the increase in the origination of conforming mortgages, whereas the increase in the origination of jumbo mortgages is only about 14 log points, or basically that 20% that I was telling you. You don't see such a differential, quantity responses during QE2, MEP, or QE3. You see, again, a very differential, quantity reaction during the tapering. So during the tapering, basically, almost all the decline in the origination is concentrated in the conforming market, and almost no reaction for the jumbo mortgages. Okay, so what are the other robustness checks that we do? For this part, it's basically we control for quanti-time fixed effects, so making sure that this is not driven with some local economy conditions. Another important robustness check that we do is jumbo mortgages are financed by banks. Conforming mortgages are financed by the GSEs. Okay, so if, for example, there is an increase in the G fees, this makes conforming mortgages less desirable, make jumbo mortgages more desirable. Okay, so we control. Andres, gave us their data on the quarterly G fees. Basically, we control for that. We see that doesn't change. Another very important factor, for example, is just the change in the spread in the bank, the change in the spread between BBB to AAA. That's a very good measure of the availability of the credit for the banks. So, for example, if credit is not that much available for the banks, and the main difference between QE1 and QE2 was that credit became much more available for the banks, and that's the reason that we see this differential reaction. We control for the credit spreads, the change in the credit spreads, and we didn't find. The main result is basically holding. So that 50 basis points increase in the spread that I told you before is going to reduce to 35 basis points in terms of the credit spread, and the quantities is even less affected. Then what we do is we only restrict to the regions that basically there wasn't any change in the conforming loan limit. The result is almost the same. We look at a broader window instead of 3 months, looking at the 6 months. Again, things are very similar. And then you can also look at the numbers instead of loan amounts. Okay. Whatever I told you so far, it was only about the origination of new mortgages. So it was about mortgage. Now, I want to move from mortgage to household, because at the end of the day, the main driver force of the economy are not mortgages, are the households. Okay. So households, now the way that you can think about this is that a household is facing these different options that they have, and then they can choose different options to do. And this is exactly what we want to do. So let me start with this hazard regression that we are running. So what we do is this, that we can look at these households with different LTV because we have their credit report, and we can track these households and we know exactly where they are. So we can impute what is their LTV before refinancing their mortgage. Okay. And then we also know what was, for example, their credit score, what was their loan amount before refinancing their mortgage. Okay. And then what we want to do is that if you are a person, for example, with LTV of 90%, or if you are a person with the mortgage loan, outstanding loan amount above the conforming loan limit, how does that affect your probability of refinancing? So that's the first thing that we want to do. So the first thing is just extensive margin. In order to do that extensive margin, we are just running these hazard regression models. That it's just the probability of refinancing as a function of your, the borrower characteristics. And this is basically, very much related to the job market paper of the Christopher. Okay, so the first thing that you see here is that, first of all, if you run for everything, it's definitely the case that the probability of refinancing, especially in January and February, increased a lot. So if you look at, for example, the months of January of 2009, the probability of refinancing increased by about 125%. If you look at the February, it's increasing by 200% compared to the refinancing probability in the 3 months before the start of the program. But as you can see here, if your LTV was above 90%, the probability that you are going to refinance your mortgage is about 50% less. Okay, so it's true that even for people with LTV of above 90%, the probability of refinancing increased, but it's much less than what it happened if your LTV was less than 80%. And then if the size of your current mortgage is jumbo, the probability of refinancing is also slightly less. Okay, so the probability that you are going to refinance your mortgage is about 20% less. Okay, but if that was the only story, it still seems that as if there was a lot of a spillover. It's true that for people with LTV of 80%, the probability of refinancing increased by 200%. But even for these people, it increased by 120, 130%. So that's still a lot of a spillover. Okay. So now we want to see how actually these households refinance their mortgage. Because if you know that at the time there weren't that many options for you to refinance a mortgage with LTV above 80%, this is exactly where this CRISM data is helping us. We could do almost everything before this point without this CRISM data. Everything after this point, we really need to be able to track borrowers between the previous mortgage contract that they had and the new mortgage contract that they had. And before showing you this result, I think it's important to distinguish between 3 types of refinancing. One is that people can do a cash-in refi. What is a cash-in refi? It means that you are liquidating some of your liquid assets. You are bringing that onto the table. You are reducing the balance of your loan, and then you are refinancing your mortgage. There is also just a term refi or no cash out refi that, you just go to your bank, you say that I have enough equity, just refinance my mortgage to a lower interest rate. And there's also a cash out refi. That's when I refinance my mortgage, I also cash out some money. And then you can imagine that these three different types of refinancing can have very different effects on the consumption. So if you are doing cash out refi, it increases the amount of liquidity that you have. That means that you can increase your consumption beyond just the interest saving that you have on your mortgage contract. Whereas if you're doing a cash-in refi, this means that at least before doing the cash-in refi, you cut your consumption to save more, reduce your saving, and then basically do the refinancing. So these different type of refinancing can have very differential effects can have very differential aggregate effects. So a little bit of detail. So we assume that, for example, we have to impute the LTV of the person before refinancing, and we just add $3,000 into the balance of the mortgage before refinancing because we want to add the closing cost of a mortgage. So $3,000, between $3,000 to $5,000 is the number that people usually report for the cost of refinance. For the closing cost of refi. Okay, so this is the distribution of mortgages conditional on refinancing. This is the distribution of the imputed LTV before refinancing, conditional on refinancing. Okay. And here I'm just showing you for those that their imputed LTV was between 80% to 90%. Okay. And this is how the distribution look after they actually refinance their mortgage. So the main thing that you see is that a lot of these households that their actual LTV was above 80%, the way that they refinanced their mortgage was by bringing some cash into the table and refinancing to a new mortgage with 80% LTV. Conditional on reducing your LTV, people on average brought about $12,000 of money onto the table in order to be able to refinance to a mortgage with LTV less than 80%. Okay. That was, this graph was for December of 2008 until June of 2009. And this was before the HARP became effective. If you look at the period, this is the 6 months after the HARP became effective, at least the first round of HARP, you see that this bunching behavior is much less pronounced than before. So for example, if you look at, sorry, let me go back here. If you look at this bunching statistics, it's about 40% before the announcement of HARP. About 40% of mortgages that they refinance and their LTV was above 80%. They refinanced to a mortgage that the new LTV was below 80%. After the announcement of HARP, this bunching ratio reduced from 40% to 18%. Okay, and it's important. Here we are not showing the bunching only for those mortgages that were eligible for HARP. If you show this only for those mortgages that were eligible for HARP, the bunching rate is even lower than that. It's only about 5 to 10%. Okay. Then you see a very similar thing also for jumbo mortgages. So here what I'm showing is, this, again, the distribution of jumbo mortgages. This is, this is the jumbo mortgage, the size of the jumbo mortgage if you normalize it by the conforming loan limit. So basically, 100 means that you are exactly at the border of the conforming loan limit. 140% means that the size of your current mortgage is 40% more than the conforming loan limit. Okay. So this is the distribution of those jumbo mortgages, those mortgages with outstanding loan amount that was a jumbo that they refinanced, and this is what they refinanced to. 45% of these households, they just refinance to a mortgage that is below the conforming loan limit. So again, the way to think about it is this, that these jumbo households facing two options. One is a very hard jumbo mortgage to get, or very low rates on a conforming mortgage, but the only way that you can do that is to bring a lot of cash into the table. These are much larger mortgages than the previous ones that I showed you, so that means that conditional on bunching, they brought about $80,000 of their own savings into to reduce the size of their mortgage in order to be able to refinance this mortgage. Okay, and of course, there's also always a cash-out refis. Okay, if you look exactly the opposite of what I was telling you, if you look at the households with the LTV between 70% to 80%, that's the nice thing about the GSE pricing. That the GSE pricing, they have a range of 70 to 75% and 75% to 80%. So, if for example your LTV is 72%, your rate is not going to be any different, whereas your rate is if your LTV is 74%. So all of these households that had some extra equity, they had the incentive to, I mean, whenever they are refinancing their mortgage, just cash out some little amount of money. So again, I mean, conditional on bunching, you see that these households that they were below the 80% limit, they cashed out about $10,000 of the money. Okay, so let me just, in the last part, I move to the implication of this also for the regional economic activities. So here we are showing the percentage of outstanding mortgages for each county, sorry, for each state that were refinanced during 2009. Okay. And you see that the states that were hit the hardest with the financial crisis, like California, Nevada, Florida, these are exactly the states that benefited the least from refinancing activities of the 2009. And here you have places that, I mean, they weren't hit with the house prices, and therefore they benefited a lot from this, I mean, from all of the refinancing activities of the 2009. So what's the main message of that? Why did we love refinancing? Because we thought that this is going to help all of these regions that basically they are in trouble. But then this is basically saying that unless you do something else on the mortgage side, unless you do something like HARP, like HAMP, all of these other complementarity programs, just playing with the mortgage rates is not going to be enough. So basically, you always need a complementarity actions from somewhere else. So the Fed cannot be the only game in the town if you really want this to be effective.
It's a difficult paper to discuss because it's a very good paper. The authors have done a lot of good work. It's a pretty important question. So if you think of all of the ingredients of a good paper, it should be on an important question, a question that matters. I think this is sort of the preeminent question in the last 4 or 5 years. It should also be a well-executed paper, something that's carefully done where they've thought about the issues intensively, and I think they've done that. So it makes my job hard. Let me try to summarize a little bit of what the paper does, and then I'll try to pick at things the best I can. So what they do is they try to look at what QE does. So does QE work? The way they've phrased it is they've asked, can we investigate the channels through which LSAPs work, how they affect the real economy, and then can we look at how it changes the composition of assets? Right, so that's a longer way of saying, does QE work? Again, this is a hugely important question. They motivate it really well. If you needed more of that, the Fed increased its balance sheet by a factor of 5 in the last 4 or 5 years. That's an enormous change. I mean, if you put this in context, it's unprecedented, right? We've never had a central bank be as active as we've had the central bank be now. And I think people will be thinking about what the implications is of that kind of activism going forward for the next maybe 5 to 10 years. In this paper, they focus on housing markets, right? So they are looking at whether the impact of Fed policy leads to a decline in interest rates. They then spend some time thinking about the impact of the policy on credit. And then I think this is the first paper I've seen do this. They also look at the refi impact of Fed policy. I recollect when I was at the Fed, I would sit in meetings where bankers would come to meet the governor and meet the chairman, and to their consternation, to the policymakers' consternation, they couldn't understand why they've brought down both the long rate and the short rate, and the refi activities just weren't taking place. And the bankers would tell all kinds of stories, but it was a big puzzle, and this is the first paper 4 or 5 years after the fact to come and try to make some progress on that front. So what's the theory here, right? So you've heard that if markets are frictionless, then Fed policy should not matter. That's true. And then you have a couple of theories that identify where it might matter, right? You have theories of if you buy up safe assets, then you're going to be increasing the demand for riskier assets because people are going to shift their portfolios a little bit. So that's one mechanism. Then the other is on the time frame. If you buy longer term debt and there's some kind of fixed preference for that kind of debt, if these markets are very segmented, then that's going to push down yields at the long end, and it's going to offset the fact that that you can't act there. And so by pushing down yields at the long end, if people depend on longer-term credit for investment, then that's another key channel through which Fed policy might work. So I think they've done a very good job in outlining the theories at work. And the challenge as an empiricist, it's a huge problem. Fed policy, it happens, at a given point in time. It's not exogenous. It's precipitated by what's going on. And unfortunately, it happens to everybody at the same time. So if you're an empiricist and you're trying to study the impact of the policy, this is the big challenge, right? They focus in particular, or they find their big findings in particular on QE1. QE1 begins in 2008-09 and goes through the middle of 2010. That's when things are at its worst. So it makes it even more difficult to get some traction here. So what they do is, and I think this is very clever, what they do is they exploit the differences in the intensities of purchases. So with QE1, the Fed was buying both Treasuries and MBS. Then that changes in QE2. It changes with the MEP, where the Fed starts to flip its buying of these types of assets. And it changes again with QE3. So they're going to use, in a very clever way, they're going to use the different intensities of the buying across Treasuries and MBS across time and exploit that to see if they can tease out the impact of the policy on real outcomes. So the benchmark specification is the following. They're looking in particular, let's say, on the interest rate. This is an indicator for QE1 or QE2 or the MEP. And then what they're asking is they're saying there's a great deal of segmentation. People that get jumbo loans, those loans are not treated. They're not part of the treatment group, but people who are getting the conforming loans or the conforming loan segment is the treatment group. Now, I went to bed last night pretty convinced that this was really a strong way to do it. I woke up this morning, I'm a little less certain. So it hinges on the idea that there's a great deal of segmentation between the jumbo loans and the conforming loans. And so I'm not sure which way the interpretation goes here. So I'm thinking out loud, if you buy the idea that jumbo loans are very different, so this is clearly the untreated group, and they're different in key ways, then the impact of the program can be sort of clearly identified by the estimate, the theta 2, conditioned on the fact that you're controlling for observables in key ways. But if you think that there might be some, or there might not be a segmentation as intense as we think, so there could be some spillovers here, then theta 2 would sort of underestimate the impact of the policy on the conforming loan segment. So in essence, if segmentation is weak, then the exercise is sort of, I would think, even stronger, because you're not necessarily, in this case, you're underestimating the impact of QE on the conforming loan market. So that's a good thing, I think. But again, the key argument here is that you need to clearly convince the reader that the segmentation exists in a way that's not an endogenous case. So it's not the case that these guys are so different, that the treatment and the control group are so different that it's difficult to parse out the impact of QE1. What do I mean by this? I mean people that are getting jumbo loans are fundamentally different than people who are getting a conforming loan. And we need to be mindful as to whether we're able to control for the differences on the demand side. Now, that being said, I think the authors have done a great job. Embedded in the specification, they're controlling for FICO scores at a very fine level. They're controlling for county by time, fixed effects, and so forth. So you could quibble and you could tell stories, and I think I encourage you to tell those kinds of stories, that there could be some latent bias on the demand side here. But in terms of the state of the art, it would be quite difficult to construct, given the data they have, it would be quite difficult to construct a better set of specifications. Okay? So what they find, as you just heard, that QE1 was particularly effective. You know, so I've picked at this a little bit, but ultimately the Fed in 2008 and 09 and 2010 was the only game in town, right? The Fed was buying up all of this stuff. So if you construct this kind of a policy experiment and you find that indeed QE1 was very effective in lowering the interest rates for the conforming loans, I'm going to quibble. I've quibbled a little bit on these specifications, but if you look at the big picture, if the policymaker is the only game in town, you would expect to find these kinds of findings, right? So it's very good that we found that Fed policy makes a difference here. They also do some work on the county level stuff, which I won't spend a great deal of time on. I think the interest rate stuff is interesting because it's being done at the individual level. Then I think this is very neat, where they're able to look at whether QE1 accelerates the time to refi. I think that's sort of the first compelling set of findings we have, that monetary policy, independent of HARP and HAMP, had this kind of impact. So let me pause here and say I'm going to pivot a little bit and say that I'm convinced of the findings. I think what they've done is plausible, and I like the paper a great deal. Now some comments that I think could make it a little tighter. One is, if we're concerned, if we have this still residual concern as to whether it's QE or whether it's something else that's going on at the same time, why not use weekly or monthly data on the intensity of Fed purchases of treasuries and of MBS across time from 2008 to 2012 or 2013, and sort of create a panel specification where you have Fed purchases of treasuries and MBS, and then the ratio as well, and then you interact that with whether it's a jumbo loan or not. So therefore, what you would do is you would be able to nest QE1, QE2, the MEP, and the taper in one big specification across time, and the treatment effect would effectively be a continuous measure of what the Fed is doing at each week or at each month. And then you would be able to really say, look, economic conditions are changing over time, and economic conditions was very different during QE1 versus the MEP. What I have is this continuous measure of treatment, and I don't think that economic conditions are changing weekly for these people. You could argue it's changing at a quarterly level, and then you're able to document that indeed, when the intensity of Fed purchases changes from treasuries to MBS and or vice versa, you see differential impacts on the interest rate vis-a-vis the conforming loans and the jumbo loans. I think that would give you a very tight way to test this. I want to phrase it a bit more carefully, a tighter way to test it as well. So here I should put my name in smaller font. These guys, have done amazing work on this paper. There's a classic paper that these authors have done that show, I'm being a little, that show that when people get a cut in the interest rates, they go and buy cars and buy stuff. And I was wondering whether it's possible to extend this work. So they have access to the CRISM data. So could you look at, after somebody, after they get a refi, do you find that there's an increased likelihood of paying down debt or going to buy a car or something else? Then that would connect in a reasonably tight way Fed policy to the refi and then to the decision to go buy stuff. And that would be sort of one of the first papers to document, not just in the abstract that mortgage credit is changing, but that by lowering the cost of credit, you can then go see people going to buy stuff. And I think that would be a really compelling way to make the argument that we're able to document the real effects of QE here. I thought that the distributional consequences in the paper were fascinating. I mean, if you take it at face value, if I read it properly, what you're effectively showing is that QE and Fed policy is helping people who were really not the ones in need of this kind of help in the first place, right? You showed that with the graph at the state level, where it's the states that were doing okay in terms of house prices. Those are the guys that jumped in and said, we've cut rates, let's take advantage of this. And the households and the places where people are struggling were the ones who are being screened out of this kind of a policy. So I think it would be interesting to study whether QE and Fed policy post-crisis is sort of working to increase the inequality in consumption across time, right? Again, with the data you have, I think you could get at some of that, or that might be a separate paper as well. And then also, the big question in the room is where are the banks? Banks have been complaining a lot about QE. The fact is, we all know that QE is going to compress yields. It's going to squeeze bank profits. There's been some work done that shows that, when banks get squeezed, they're going to pull back on credit extension, and they're going to, extend credit to the people with a good risk. Could this be a channel that offsets what you're finding? And so this could be something that you could take a look at as well. So, to begin to wrap this up, I think to put this paper in a broader context. So I think they've done a great job. I like the paper as is. There are a couple of things that they could do to tighten these specifications, but I think that's not a big deal. Where I think it fits nicely is that there's a big debate now about what is QE doing? Is it taking on? Are people taking on additional risk? Is it beginning to affect the currency as well in interesting ways that matter? In this paper, we're seeing that the benefits tend to be very focused on particular groups. So this, if you believe that economics matters insofar as you're able to shape how people think, I mean, this is a great paper to make the argument, as you just did, that you need the fiscal policy part of this as well to mitigate these costs, right? If you operate alone as a central bank, you're getting some traction, but the side effects here are going up and up and up, and then you need to begin to step back and say, is this a time to pull back as well, unless you get this, right? So let me conclude by saying, in Donald Trump language here, this is a hugely important question. They've done a terrific job, and I would like to see a bit more on banks, a bit more on the redistributive channel as well. I use a Donald Trump quote here. I think there's an interesting paper to be done where if you can study the segmentation of QE and look at how that's affecting voting, I conjecture that the people who didn't get the benefits of QE and Fed policy are probably the people who are voting in the other way now. So I think it's a fascinating set of things to study. Go ahead, Andreas. Sorry.
So one comment on the cash-in result. So you argue that that may actually have a negative effect at the macro level, but I'm not sure I believe that, because these people that have cash lying around to pay down their mortgage balance are likely not constrained. You can look at that actually in PRISM. You can look at who these people are, what their credit scores are, what their credit utilization ratios are, to actually shed some light on this. Second comment is I think you should not drop FHA mortgages, which tend to have higher LTVs, and so your bunching results look a little less dramatic. And FHA was a big part of the market at that time, and the Fed also bought GSE MBS, which are FHA mortgages.
I saw another hand too.
Yeah, about the mechanism. So if I understand the result correctly, I mean, of course there needs to be some segmentation, but this difference between QE1 and QE2 somehow suggests that at the time of QE1, mortgage-backed securities and long-term treasuries were somehow not good substitutes for investment. Because Well, because it's not like a maturity thing. It seems to be actually buying mortgage-backed securities as such. And so I'm just wondering, like, what is that? You know, why? I mean, because the GSEs at that point were basically had been taken over by the federal government. So you know, they're the debt that we're issuing. So I mean, should we think that if the Fed had bought long-term treasuries instead of MBS for QE1, you know, this effect wouldn't have been there? I mean, I just wonder why there would be this kind of segmentation between MBS and long-term treasuries. The prepayment risk that investors were unsure about, or the questions about the legal status of the GSE at that point. Like, I just don't fully understand.
Yeah.
Because I know I understand the maturity segmentation argument, but like this difference,
okay.
I think it would be good to see some kind of story here.
Yes. Yeah, to the point of whether jumbo borrowers are somehow different, I mean, one thing we know is jumbo borrowers are a lot more likely to use ARMs than fixed-rate mortgages. I'm assuming you're only using fixed-rate mortgages in the study, but still, I think the substantial majority of conforming conventionals are 30-year fixed. And I wouldn't be surprised if a very high majority of jumbos are ARMs. And that's partly because you can get a lower interest rate, and also jumbo borrowers tend to be wealthier and more financially sophisticated, so they don't mind taking a little interest rate risk. You know, having said that, I thought the risk-adjusted rates and the cash-in refinancing were both really interesting. I haven't seen anything on cash-in refinancing done before, so I thought that was a particularly interesting event.
Yeah. I mean, there's a couple of things that sort of concern me. One is that implicitly, I think you're assuming during Q1, Q2, Q3, there's a ceteris paribus that's really very hard to buy. And that in particular, during QE1, there was fiscal policy, TARP, and there was also intervention in other markets, in short-term markets, commercial paper market and so forth, which really, in a sense, proves that the fiscal policy really matters, okay? And I think you need to sort of in some way bring that in. I mean, obviously just seeing what you saw here, you may say this in the paper. Second, there's a lot of money coming in from overseas, and the zero lower bound interest rate on the short end may be affecting real decisions on how to invest, and that's that's obviously the the Larry Summers and all that stuff that's been said. And third, on the cash-ins, I think you may find a cusp point where the cash-in mortgages occurred when people tried to get just before they changed the limits on the conventionals. There was a point when and that point, a lot of people cashed out. Now, there's another point to be made in this, in that while you haven't changed the net worth of people, you have changed their liquidity. And that does change their behavior. And in fact, that may increase savings, not increase consumption. You follow what I'm saying? Those are my 3 points.
The floor is yours, Amir.
So just, very quickly, Rodney, thank you so much for all of those good comments. It's really good. Yeah, it's just a lot of very interesting stuff for us to do. Just one thing about running the panel regression, I think that's the best. We should definitely do that. The only challenge is that how much of the changes in the flow that you see was expected and how much it was just unexpected, because I think the unexpected change in the flow is more important, but we should definitely do that, and as well as other things. So I think the points that Rodney said, we should just do it. So Andres, thank you so much. I think you're absolutely right that we should definitely do more on finding out what are these who are the people who are doing these cash-ins. For example, another place that these cash-in is not going to have a huge consumption effect is if people are using their pension funds, their 401k, to take out some money, to borrow from their own 401k to bring some cash. So, and you're absolutely right. So we should just, look at what are the characteristics of these people who did a cash-in, compare it with the characteristics of other people who didn't do a cash-in. FHA, actually, you are, again, another very, very important point. I think it was 3 weeks ago, I was showing this in my class also, that so there is this very nice graph, the change in the share of FHA as a function of the change in the house prices, and exactly the regions that were hit the hardest with the decline in the house prices are the places that FHA was the only option for them. So maybe we have to bring back that in. The problem is this, that not the problem, I think it will have a little bit of less of an effect on our setting, because FHA mortgages, most of them were not a refi mortgage, other than those loan modification programs. They were super important for the first-time home buyers and for the new buyers. So they kept the flow of new buyers in many regions. But we should definitely also look at how much these results will change when we include the FHA mortgages. I think in the beginning, because there were many changes in the program of the FHA, we just excluded them from the program. I think it definitely, and we should definitely do one of these as a robustness check. Tim, just to your point about why is it different, I think the main reason that it's very different during QE1, whether they purchase treasury or mortgage-backed securities, is this, that the only way that you can create more mortgage-backed securities is by refinancing more mortgage. Okay? Whereas you can purchase treasury just from the market. Okay? Because all the Fed purchase was in the TBA market, that is, it's a little bit of a detail, but in TBA, it has to be filled with the almost new originations. You look at the lens. It's
typically is. There's no rules.
So let me say it this way. So Fed publish all of the QSIPs that they purchased on their balance sheet. Yeah, it's because.
TBA market, you can put anything.
Yeah, but then you have to purchase all of these things to make sure that it's the way that it has to be new, because it should be a TBA on RON. And then a TBA on RON is usually the interest rates that are close to the current interest rate. You can include things that have a much higher interest rate, but then you have to purchase these interest rate swaps. It doesn't worth doing it. So it will become more expensive. You can do it, it's just more expensive. So they don't do it usually. For that, but it's basically, that's the main difference, that the only way that you can create these new things is by refinancing more, which is very different from purchasing something that, so in other words, it's as if there isn't that many investors either for treasury or mortgage-backed securities, private investors. The Fed is saying that I'm increasing the demand for these mortgage-backed securities. It's going to increase the supply of that. Okay, and then, to the point about jumbos are mainly ARM. So for the quantity, for the interest rate results, we only look at the fixed rate mortgages. For originations, we include both ARMs and fixed rate mortgages, exactly for the point that you mentioned. There is another thing that maybe is related to what you said, which is if I have an ARM, I don't have to refinance my mortgage to benefit from these lower interest rates, because it just happens automatically. That will affect the level of refinancing of fixed rate mortgage, the level of refinancing of jumbo mortgages in general. Okay, so for those graphs on the quantity results that you saw, it's true that on average, a lot of jumbo ARMs are just not refinancing just because they benefit from these rates automatically. But this will affect any reduction in the interest rates, not only during QE1. And that's why comparing with the other episodes of QE2 and QE3 is also helping us. That basically it's true that on average, if the refinancing volume activity of jumbo mortgages can be lower because a lot of them have ARM, but that will affect all of them, not only during the QE1. And then Bob, I think there is definitely actually this TAR program was super important in recapitalizing the banks. All of the evidence that we have from CDS origination, there is this very nice graph that it shows that the Treasury announced the TAR program, the stress test. They say that we are going to do the stress test. The CDS of all banks jump up, and then they announce the results. Everything comes down. The market, they gave a lot of confidence to the market. And maybe the banking sector after that was a bit different. So I think one thing that we should do is looking at the recapitalization of the banks and the financial health of the balance sheet of the banks and how that affected the origination of especially jumbo mortgages, because the health of the balance sheet of the banks before the program and after the program was very different. Foreign money is definitely important. I'm not sure how much it will affect the the refinancing activity. And the change in the conforming loan limits, it's very interesting. So in the graphs, actually, if you look at the conforming mortgage originations, exactly before the expiration of the program, you have a spike, which is exactly because of this, that people knew that it's going to expire in September of 2011, I think it was. A lot of people just rushed into this to just refinance before there was a reduction in the conforming loan. So that's definitely another place that it had that effect. Thank you.